Good morning, traders. Today is July 24th. I am going to talk to you today briefly about how the markets are setting up on a cyclical basis and why we need to stay concerned over the next 12 to 24 months. Particularly, I'm going to highlight the excessive debt and credit crisis that's taking place throughout the world as the Fed continues to raise rates. On Twitter yesterday, Alf, a friend of mine on Twitter, posted a very interesting comment about what if the Fed raises rates and what is their ultimate intention with regards to raising rates and what will be the outcome. It really comes down to a couple of things, in my opinion. Inflation has gotten out of control, which is partly because of COVID and partly because of the extended credit that the global central banks have provided. Easy money means people pay ridiculous, stupid money for things throughout the world, and that drives inflationary pressure much, much higher. When we combine that with a COVID crisis that disrupts supply, and you still have this easy money and excessive asset prices throughout the world, then you have what I call stupid money. They chase everything. For example, yesterday I was watching the Mecum auto auction, and it's amazing to see these vehicles sell for 200, 400, $900,000 or more, that were literally, 40, 30, 40, 50, 60,000 3 years ago. The idea is people just literally are awash in cash and profits, and everything looks good except when you consider that it's all essentially credit. So this is my long-term cycle analysis. This goes back many years, and you can see these red areas here are typical topping phases, and these green areas here are typical bottom phases. Now I've marked the historical trends, projected trends in black. The real market trends are highlighted here in this gold color, and you can see they become a little bit more aggressive. The cycle is tightening, becoming faster. You can see here the bottom in 2003 roughly, and then we had the top up here in 2008, 2009, the bottom back here in 2009, 2010. Then we had a brief cycle rotation in 2015, 16. Fed was still pumping money into the market, but we had that rotation. It bottomed down here around 2016, 17, which started a new rally phase. And this is where we're at right now, where it says now, this gold line here, roughly end of 2022, middle of 2022, roughly. And you can see that we're early into a cycle topping phase here. So if we get into an early cycle topping phase with the Fed raising rates, we could see this adjust very quickly within the next 6 to 10 months, possibly into a broad market decline, and we could be looking for some sort of a moderate bottom phase here. Now, eventually, if this were the case, we would see some sort of a rally phase up until this area, 2028, 2029, potentially reaching some sort of a peak up here and ending with another bottom phase back here around 2034 or so. So understand that we're very, very close to a cycle topping phase. And I want you to understand what's actually taken place to cause this and why I think China and the Fed is going to do this. So briefly, I'm going to tell you that the Fed's intention, they will state, is to combat inflation. The actions they're taking by raising rates are going to do a couple of things. Number one, it's going to try to pull capital excess out of the market. So they're going to try to pull some of this excess capital out of the market. And by doing so, they're raising rates, causing the cheaper credit to have to get rolled over into new credit when the bonds expire or when the loans become due. That means that loans that were out at 1 or 2% now need to be satisfied and repaid and taken back out at, say, 3 or 4 or 5 or 6% or higher. That's going to put a lot of pressure on the global markets. They're either going to have to repay these loans, they're going to have to roll them into new debt instruments, new loans, or they're going to have to default on these loans, which is something that we're going to start to see. Now, secondarily, we're going to start to see a lot of currency fluctuation. As we see these at-risk economies, emerging market, Asia, China, come to terms with the fact that they are not going to be able to carry cheap U.S. debt very long, and they're going to have to straighten up their books on their excesses. You're going to start to see a lot of currency fluctuations. We're already seeing it. Japan is going through a massive crisis. Zimbabwe, all types of currencies are really blowing up with what's going on. And that's going to present another issue that we'll talk about later. But understand that debt risk and liability risk will translate into currency risk. And in a way, what the Fed is attempting to do is to stall inflation, but at the same point in time, they are inadvertently creating currency disruptions. So now what I want to do here is highlight the cycle trend that we're likely to see in gold and silver. As you can see, we've seen a broad cycle phase during disruption. This is 2009 bottom. This is the 2015-16 bottom. This is the COVID bottom. And now we're reaching this peaking formation, which may send us into another bottom. In fact, I believe gold just likely stalled out and bottomed just last week around 1700, 1694, I believe it was. So we're at the early phase topping cycle here. You can see we've rolled over. I believe that this is going to continue to decline as the Fed continues to push the interest rates higher. And I believe gold and silver are going to become excellent hedging assets as we move higher as well. So be prepared that we're going to start moving into a very, very similar pattern to right over here. In the sense that 2008, 9, 10, we saw gold and silver contract a bit. We're seeing that same thing happen right over here. We've set up a nice double bottom. We've seen a fairly big downturn in the S&P. The next phase is not necessarily for the Fed to flinch, but for global markets to flinch, to start screaming that the Fed's actions are disrupting their potential stability and future performance, and that will send gold and silver skyrocketing higher. Potentially, in this case, this was a 400% rally. You can see plus percent. If we were to go a 400% rally in gold and silver from where we're at right now, we'd be talking $6,500 to $8,500 gold or higher, and we would be talking $90 to $120 silver or higher. So pay attention. This is all coming over the next, in my opinion, 6 to 24 months. Now let's get back onto the growth in China. Particularly, I'm focused on China and Asia. So I want you to pay attention to the growth. This is online loan. This is not traditional banking system loan growth. This is through online applications where they're offering buy now, pay later, essentially online credit, predatory lending, just like, many are familiar with the GFC crisis and the predatory lending that took place back in 2004, 5, 6, 7, 8. But look at these online platforms. Just in the last literally 5 years, look at this growth from 0.3 to 6.6. I'm going to do the math here, but that's a 20,000% increase. Okay, do the math here. 1.2 to 13.5. That's a 1,100% increase. It is a massive amount in trillions of won of growth in shadow banking and shadow loans that are handled through financial institutions, buy now, pay later. China has really run under the table, so to say, shadow banking, which is, excessive. In my opinion, when you take a look at 2017 or let's go 2018 to now, which doesn't include 2022 right now, just take a look at this from 3.6 to here, a 500% increase. From 0.9 to 6.6, an almost 650, 750% increase in online banking, in the number of trillions of won. Add these two together, okay, online platforms versus financial institutions, you have 21 trillion in won in growth from 1.5 trillion, or in this case, let's call it 4.5 trillion in won to 21 trillion. That's a huge 600% increase in liabilities. Now, liabilities become a very critical issue. We come back over here and we take a look at this. These are some articles I found. This is from ZAWYA regarding global debt hits record 305 trillion driven by China and US, produced by the IIF. But take a look at this chart. And what I want you to see here is notice the US in blue. Yeah, yes, we've increased our debt marginally. You know, we could say that we've over 2012 to 2022, we've increased our debt by maybe 40, 50, maybe even 70% or higher. From the bottom over here, 2012 until now. Obviously, 2020 and 2022 were wild with regards to the Fed prompting debt issues. And we have a lot of Fed holdings as well. Take a look at the euro area. Euro area has grown, but not excessively. Take a look at U.S. mature markets, excluding U.S. and EA. So here we have pretty much the same level, moderate growth. Take a look at China. From 2012, you got this little sliver here, and you've got this huge block over here. I see this as a 500, 400, 500, 600% increase. And you look at emerging markets, emerging markets have almost doubled their size of debt in regards to just total debt. So when you look at the global debt here, you take a look at the range between this peak and this peak, and you can see essentially that this might be a 40, 50, 60%. This might be a 25, 30%. This might be a 30 to 50%. This is a 600% in comparative size. And this is maybe an increase of 180 to 100%. Now, when you take a look at the government financing needs to remain substantial, this is what financing requirements are in red for these different areas versus the 2015-19 average. You can see here EM Asia, emerging markets Asia, is excessive financing right now. Emerging markets are excessive. Emerging markets Europe are excessive. Latin America is moderate. You can see here Euro area is excessive. EU is excessive. We're really at a point right now where government financing is presenting a very real issue. They're pumping out loans to anybody who will take them. And the real reality, as I stated, is that in a contractionary market, you're going to see these loans become risky. So we're going to have a scenario where they either have to be repaid, resettled, renegotiated, or defaulted. And that's where we're coming up to a really interesting scenario. Now, the Financial Times had a very interesting article showing how investment demand drives economic growth. Now, this is contributions to China's GDP, consumption expenditure, investment, gross capital, and net exports. And then, of course, we have something up here. Real GDP growth looks like is the red line. Notice this contraction over here in 2020, 2015. This is a growth phase here. This was the global financial crisis that took place. This was China's continued growth through the 2011, 12, 15, what have you. And now look at this contraction through into 2020. I'm betting that we're looking at close to negative numbers right now in 2022 with the real contraction taking place in China. And remember, China's real debt is in excess of the wrong one, back over here, hold on. China's real debt right now is in excess of 600% what it was in 2012. And that's just the actual debt presented by the government. Now, there is a graph over here representing China official shadow and local government financing. Official number is right here at about 460, 440,000. A local government debt is approximately 150 billion. Sorry, these are billions. And then shadow banking is approximately 65, 70 billion. But again, look at the growth from this area, this total area, 150 up here to 450, And that does not include the online banking, which we've already seen to be in excess of 20 some trillion. So we're looking at massive liability issues in China, and slumps persist. You're seeing home price sales, new home prices have fallen for 10 straight months. And this is where the real crisis comes in the sense that we're going to see really severe downward contraction over the next 5 to 24 months, and we need to be prepared for this. I think that the Chinese and Asian and emerging markets are likely to become the next big crisis event taking place. So now, this I found on Reddit, which was very cool because it had a lot of data. So we're going to look here. Most major developers saw their monthly contracted sales fall over 50% in April. This is from April of 2022. You can see here we're seeing massive contraction in actual loan origination and spending. April's worst sellers. So here's a list of the home sellers which were selling, and you can see they've seen this was back in April. Just remember, 3-4 months ago, we're seeing massive selling in the sense that we're seeing a contraction in excess of 50 to 70, possibly 90% in all sellers in this area, the worst seller. This is the real estate drives prices, drives between 20 to 30% of Chinese GDP. If it drives 20 to 30% of GDP and we're in this extreme contractionary phase, we could see this last for many, many months. The unwinding of this excess bubble is just incredible. Of course, here we have Greenland Holdings bonds falling sharply, and this is what's going to happen. Credit markets, bond markets, corporate bond markets are going to start pricing in the unsustainable debt levels and the untenable real estate and economic model that's taking place. And we are going to have a very unruly unwinding take place, in my opinion. April's record-breaking default rate. So here we have debt issuers monthly. These are domestic. These are offshore. So yellow is domestic. Light purple is offshore. Default rate is dark, kind of a gold color, and offshore rate is a purple color. So you can see here, offshore debtors are just skyrocketing in April. And this is something that we need to be aware of, that the markets have changed dramatically. We are seeing massive default rates, which is what's going to happen, in my opinion, going forward. If we do not see growth in the economy, we are going to see contraction in the economy. And as I've always stated, extended declines, -10, -15%, are excessive. These are massive declines for an economy that has been banked on growth for more than a decade. And for example, the way this works in China is someone buys a house. It goes up, say, 100%, 80% in value. They leverage that to buy another house, put all the money into that house, continue to try to make the payments. They feel they're rich. They've taken the profits from the first house, leveraged into a second house. Now that second house goes up while the first house goes up again. They leverage them again, buy a third house. It continues to move higher. They leverage again, buy a fourth or a fifth house. On paper, everything looks great until it starts contracting. These people, these buyers, are so indebted. Even though they own the real estate outright, they are so indebted that if the market turns and prices start to collapse, they will essentially be wiping out large amounts of real value in their accounts. And obviously they could be maintaining these properties and selling them later, but it is a major decline in total GDP and total economic sales. So now over here, credit to non-financial business sector. This is very important. You can see from 2009, we were about 85%. This is non-financial business sector. We've almost doubled the credit into the Chinese market for non-financial business sector. And here's sales going back to 2013, 14. And I really believe that this is going to collapse way, way lower, much, much lower. Okay, I don't want to waste too much of your time. I want to highlight some things here that are taking place, and I want to point out the U.S. to global markets here are really in a very fragile scenario. And what I want you to realize, if I can get my mouse to move, what I want you to realize is that the U.S. markets are holding up quite well. The U.S. dollar will probably continue to hold up quite well, but we are not immune from these risks. When these risks start to implode, it's going to affect everything on the planet. The most at-risk economies are going to start to become affected first. Currencies will start to devalue greatly. Consumers will respond to this by stopping to spend, except on essentials, and we will then enter a period of what I would consider moderate to extreme crisis. So watch gold and silver. Gold and silver are the largest and best hedge instrument right now. You can see this chart here in gold holding up. We're back down near these lows right now. We've set up a massive bottoming formation just last Thursday. It looks like gold has set up a capitulation bottom. I'm watching it to move higher. I really want to see it try to move above the 1820, 1840 area. If it does, we're going to have very solid confirmation of a bottom in place. And we need to be very cautious of how this global market is being affected. The Fed and the European Central Bank have enough room to do some real damage. And what I think is going to happen is it's going to push at-risk economies, particularly China, Asia, into a collapse mode. And we're going to see some real destruction take place. China will likely become the next global financial crisis, and we will leave it as that. All right, guys, follow me on Twitter, follow me on YouTube, and let's get ready to make some real money in these big trends.